Hello and welcome to the November 10th, 2023 episode of Watching the Tape. A big headline this week was WeWork filing for bankruptcy. And if you don't know what WeWork does, it provides co-working spaces for individuals. And I have an example here of some of its office space in Seattle's Capitol Hill neighborhood. So let's flip through some of these pictures. You have a community bar, followed by several pictures of its common areas. There's a kitchen, it's pretty nice. More common areas. There's the outdoor space. And then you've got some more common areas. Looks pretty nice. And if you scroll down a little bit to the amenities section, you'll see that it is dog friendly. So that is pretty neat. Okay, let's look at the stock price chart since WeWork IPO'd in 2021. It peaked at over $500 a share, and now it is at 84 cents a share. WeWork has corporate bonds outstanding too. And here is the bond price chart over that same period since WeWork IPO'd. And you can see that bonds were priced at above par, actually, above 100 cents on the dollar at one point, but are now essentially worthless. When I see a company go from being worth billions to zero, I like to conduct a post-mortem to see if there is anything that can be learned from the collapse that investors can apply going forward in order to avoid investing in the next WeWork. For this exercise, let's go back in time to June 2022. 8 months had passed since the IPO and the stock was trading at $300 a share. What information did investors have available to them at that time? Well, they had access to WeWork's earnings reports through the first quarter of 2022. So that's what we're going to take a look at. Starting with top line revenues, we can see that revenues took a hit from COVID in 2021, but appeared to be trending back up through the first quarter of 2022. How about bottom line earnings? Earnings were massively negative across all these periods, and it's really quite astonishing to see, for example, $765 million of revenues in the first quarter coupled with net loss of $435 million. As you can imagine, the actual cash flows weren't much better. Free cash flow is a metric that captures the cash flow from operations minus capital expenditures. And you really want this to be a positive number, but WeWork again showed deeply negative cash flows in all of these periods. So if earnings were negative and cash flows were negative, what about the book value of its equity? And book value equals assets minus liabilities. And it was positive at the end of 2020, but then it turned negative in 2021. And again, this should really be a positive number, but in the case of WeWork, its liabilities were greater than its assets. Now, the stock price, if you'll recall, was trading at $300 a share in June of 2022. What kind of multiple did that represent over earnings and the book value of its equity? Well, with negative earnings, the math doesn't work, and with a negative book value of equity, the math also doesn't work. So those traditional valuation metrics were meaningless. At least revenues were positive, so the company could be valued on a multiple of its revenues. And that multiple was in the range of 9 to 11 times, which seems awfully steep considering that none of those revenues actually fell to the bottom line. So how were investors even valuing this company? And the answer is that they were using rosy projections of future earnings to assign value to this stock. And I really have no problems with that concept. Assets should be valued based upon the future cash flows to be generated by those assets, but is it too unreasonable to expect some track record of positive earnings and cash flows before buying into a story at $300 a share? A natural next question would be, despite its earnings challenges, was WeWork on firm enough financial footing to give it time? And to answer that question, let's see how Standard & Poor's rated the company's debt. Standard & Poor's assigns ratings to companies based upon their perceived creditworthiness. And here are those ratings from the best at the top, AAA, down to the bottom, the worst, single C. In June of 2022, WeWork's bonds were rated CCC+, near the bottom. So the answer to the question about whether or not it had a strong enough balance sheet to weather the storm, the answer is an emphatic no. And we kind of already knew that because its liabilities were greater than its assets on the balance sheet. Negative earnings, negative cash flows, negative equity, but clearly there was some expectation that WeWork would turn the corner and start generating profits down the road. But its runway ran out before earnings were able to take off. And looking back, you really have to strain to even think it was a possibility. Buying WeWork stock at $300 a share in June of 2022 looked more like gambling than investing. And I know hindsight's 2020, but anyone shocked by the insolvency of WeWork just didn't really do their homework. That is it for this week. If you found this video helpful or interesting and can think of anyone else who might benefit from the content, please share it. Thanks for watching. We'll see you in 2 weeks.